What's up, everybody? Goldman Sachs released an article this week titled, "Why the Global Housing Market Has Further to Slide," where they break down just how bad home prices could get in highly developed countries like the United States, Canada, and New Zealand. A contraction in housing starts, sales, and prices has persisted this year and shows little signs of stopping. Goldman Sachs economists Joseph Briggs and Giovanni Parademic wrote in a report. And yet, Zillow just revised their home value forecast to reflect a rise in their ZHVI, or their Zillow Home Value Index, from February's forecast, which projected a growth of 0.2% over the next 12 months to 0.6% over the next 12 months. They credit a lack of inventory as the reason home prices still remain elevated even with high interest rates. But one thing they all agree on is the present affordability challenges for buyers. So today, we're going to take a look at that Goldman Sachs article as well as Zillow and Redfin's latest housing market updates to see where home prices are heading in the imminent future. So let's just dive right in. In the Goldman Sachs report dated March 22nd, they say that higher mortgage rates will keep the housing markets in most G10 economies in correction mode through at least the end of 2023. Since mortgage rates have only recently peaked in most countries and could be headed higher still, the global housing market may have not yet found its bottom, said Goldman Sachs research. They predict meaningful peak-to-trough home price declines in developed markets where housing affordability plunged following the pandemic, including New Zealand down 19%, Canada down 19%, Sweden down 17%, and Australia down 15%. Developed markets that will likely see flat or moderate declines include Italy down 2% peak to trough, France down 4%, and Switzerland down 6%, reflecting a slower increase in mortgage rates and less stretched affordability. So what do they predict for the United States? In the GS report, they do clarify that interest rates are not the only factor when determining the housing outlook. In fact, mortgage rate increases account for less than half of the forecast variance in most countries. It's also about inventory. This is actually where Zillow and Goldman Sachs agree. Our lack of inventory will stop home prices from plummeting on a national level. But where they disagree is that Zillow thinks that U.S. home prices will increase, even if only a little, where Goldman Sachs thinks that home prices will continue to go down. An updated analysis of the Zillow Home Value Index by Lance Lambert's Fortune finds that 38% of the nation's 200 largest housing markets saw a month-over-month home price decline in February. That share has steadily gone down in the past few months. At the height of the housing correction, 79% of the 200 largest housing markets saw a month-over-month price decline in September. In October, 76% of those major markets saw a home price decline. In November and December, it was down to 64% and 67% respectively. And by January, just 47% of the nation's 200 largest housing markets registered a month-over-month home price decline. So the pattern is clear, but it will vary depending on what market you're in. As we know, real estate is very localized, and what is happening in Boise or Austin is very different than what's happening where I am, for example, in the DC area. According to Zillow, both Boise and Austin are down 8.9% from its peak, while where I am in the DC area is down 2.04%. And to be honest, where I am specifically in Montgomery County, Maryland, and DC and Northern Virginia, good houses that show well and are priced appropriately are still selling in bidding wars, in multiple offers, and are escalating above the asking price. What about where you are? Are prices going down, or are you guys seeing multiple offers and bidding wars in April of 2023 like I am? Comment below and tell us where you live and what you're seeing. Because if we look at home prices from a national perspective, U.S. home prices are down 2.7% from its peak 6 months ago, according to the Fortune article. So what does Goldman Sachs think will happen in the U.S. over the next 12 months? The Goldman Sachs research team predicts relatively tame, a peak to trough decline of 5%, owing mainly to its extremely low vacancy rate. Put things into perspective, if U.S. home prices fall 5% from its 2022 peak, national home prices in the country would still be up approximately 34% from its 2022 levels. And if you compare it to the 2008 housing market crash, this correction seems pretty tame. Home prices fell 26% peak to trough between 2007 and 2012. But the problems don't end here. The affordability crisis will only get worse with high interest rates and still high home prices. Higher borrowing costs for home buyers have weighed heavily on housing affordability, and the full impact likely hasn't been felt yet. The timing of the impact isn't uniform across the world. Differences in mortgage markets across countries can speed or slow the impact. Countries with higher shares of fixed-rate mortgages, for example, tend to experience delayed rate impacts, wrote Goldman researchers. And the recent turmoil with several banks imploding only adds to the uncertainty of the future of the housing market. The banking industry chaos of the last few weeks likely prevented the Fed from making a big inflation-fighting hike this week that could have sent mortgage rates soaring, said Redfin chief economist Daryl Fairweather. They kept the hike small partly because banking turmoil naturally combats inflation. As a result, the housing market is in a better place now than it was a few weeks ago. So what is the answer? How do we fight inflation and still create more affordable housing? Seems like this is a lose-lose situation until we get a lot more inventory. Some of your comments suggest that we're going to see an onslaught of foreclosures, which would increase inventory. According to Adam, a leading curator of land, property, and real estate data, foreclosure activity has actually started to stabilize. Rob Barber, the chief executive officer of ATTOM, said in a March 8th report, the numbers don't yet show a clear trend towards fewer foreclosures, but with historically high levels of home equity flowing from a decade of rising values, we may be seeing a growing number of delinquent mortgage payers with at least the option to sell before facing foreclosure. So far, we haven't seen a huge influx of inventory, at least not where I am, and certainly not on a national level. According to Redfin, new listings of U.S. homes for sale fell 22% from a year earlier during the 4 weeks ending March 19th, one of the biggest declines since the housing market came to a screeching halt at the beginning of the pandemic. New listings fell slightly more in the month of December of 2022. New listings declined in all but one of the 50 most populous U.S. metros, with the biggest declines in Sacramento, down 48.6%, Oakland, down 45.3%, San Francisco, down 43.2%, San Jose, down 41.6%, and San Diego, down 41.3%. They increased 1.3% in Nashville, Tennessee. Redfin also reports that active listings, the number of homes for sale at any point during the period, were up 15.4% from a year earlier, the smallest increase in more than 3 months. And the months of supply, a measure of the balance between supply and demand, was 2.9 months, down from 3.7 months a month earlier and up from 1.9 months a year earlier. This all points to a lot less inventory presently on the market, which is slightly terrifying since April is one of the busiest months for the housing markets. Zillow expects 4.3 million sales in 2023 compared to 5 million sales in 2022. This is down slightly from their February forecast of 4.6 million sales in 2023. Weaker than expected performance of leading indicators of home sales, combined with a perceived increase in higher mortgage rates, drove the downward adjustment. So all of the data points to a very tight housing market with no real signs of easing up. Goldman Sachs economists Briggs and Pierre Domenico believe that the housing declines across the globe are going according to plan. The strong housing market response to rate hikes has helped slow overall growth below trend without causing a recession or triggering a rise in delinquencies in most major economies. We anticipate that this pattern will continue. And Redfin's Daryl Fairweather said, mortgage rates are unlikely to increase again again unless the next inflation report is worse than expected. Sideline buyers should be on alert in the coming days and weeks, which could offer a window to lock in a rate closer to 6% than 7%. I do think the next few months are going to be very telling. Will the chaos from the banking industry help tame inflation? Do you want to know more about what Lawrence Yun, the chief economist at the National Association of Realtors, and others are saying about the impact of the collapse of SVB Bank and the other banks? Check out this next video. Thanks for watching. I do appreciate it. Bye!